So we do the revision portfolio management. Again, I'm repeating it so that it is on record. Okay, I won't be revising entirely. I'll be just telling you the important points, make you remember the entire chapter so you know that what all you have to do in this chapter. Nothing is missed out as such. Portfolio management, highly theoretical, so reading of the chapters is a must. Okay, they can ask you anything from anywhere, so it's better that you read all the chapters to the T, and while reading the chapters you mark the important points. Okay, fine. So starting with portfolio management and overview, here we had basically learned that portfolio management is all about what? Diversification. I had started off with the quote, don't put all your eggs in one basket. Okay, diversification is a must. Diversification means what? If you are investing your money, some part of it should be invested in stocks, bonds, gold. Some should be held in liquid assets like cash itself. Okay, now is it like a one size fits all approach? No, portfolio management is never that. It depends on so many factors: your age, your income levels, your risk tolerance capacity, your ability and willingness to take risk. Very important. Now if I ask you, between ability and willingness to take risk, what is more important, the ability or willingness? Ability. You might be having the willingness. A beggar has a lot of willingness to take risk but does not have the ability. So remember, ability always dominates the willingness. If you have the ability but if you don't have the willingness, maybe I can educate you. Okay boss, you have the ability, why don't you take risk? It's not always bad to take risk. If it is within your capacity to take risk, you should take risk, like that. So then I leave it up to you after explaining you the benefits of taking risk, right? Okay, then there was diversification ratio that we had learned. Diversification ratio is, for example, I have 3 securities. So standard deviation of the portfolio which consists of 3 securities, and in diversification ratio they have assumed that the portfolio is equally weighted. So if I have a portfolio of 3 securities, 33% of my money is invested in each security. Security A, security B, security C. You calculate the portfolio standard deviation. Now, if I pick up any one security at random, what do you think the standard deviation of that security is going to be, high or low, as compared to the portfolio standard deviation? High. Individual security का standard deviation would be high, portfolio का standard deviation would be low. So diversification ratio was what? Standard deviation of equally weighted portfolio of n securities. That n could be anything, 3, 4, 5, whatever, upon standard deviation of any one security selected at random. So the numerator is portfolio standard deviation, which would be low. The denominator is the standard deviation of any one individual security selected at random, which would be high. So diversification ratio as a whole would be low. Lower the diversification ratio, better it is in portfolio management. Yeah, so that was the entire idea of diversification ratio. Then we had done the portfolio management process. 3 steps were there. First step was planning step. Second step was execution step. Third step was feedback step. In the planning step, basically I get to know the client. It's basically a KYC, know your client type of a thing, in which we prepare the IPS, investment policy statement. Now, do I revise the investment policy statement every now and then? No, I only revise it at maybe say an annual frequency every 2 years, or when there is a major change in the client circumstances. Step 2 was execution step, where I do a macroeconomic study to select the sector, and within the sector to select the securities and all. Now there could be 2 approaches, top down approach or bottom up. Top down approach may I start with the macroeconomic picture, then sector, then industry, and then the individual companies. Okay, and in bottom up I start off with individual companies, industry, sector, and then macroeconomic study. So the choice is yours. What is your analysis style and selection style? And lastly, we had the feedback step. So you remember the concept of strategic asset allocation? Broadly, where should your money be invested? So if I have a client and I have planned a strategic asset allocation of 60% equity, 40% fixed income, in the feedback step I'll check if this has been violated or no. If say for example the weightage of fixed income has increased from 40 to 45% and weightage of equity from 60 it has reduced to 55%, so my strategic asset allocation is not in line, it is off balance. So I need to rebalance the portfolio and get it in sync with what was originally planned. So I need to get it back to 60-40. So I'll buy equities and sell fixed income, right? So this was the feedback step. Okay. Any personal constraints of the client? You remember constraints example I had given you. I don't invest in defense companies which are in the defense business and all, because that is my personal constraint. It is not, so conscience mein nahi baith raha hai, it's like that. So that all will form a part of step 1 only, planning step. Know your client mein. Fine. My personal constraint could be I want to invest in such securities, such stocks which give regular dividends. Now that is my personal constraint, may not necessarily be anyone else's constraint, right? Okay. I might fall in the highest tax bracket. That again becomes my personal constraint. So I will tell the portfolio manager, okay, please invest in such securities which are tax efficient because I fall in the highest tax bracket. Okay. So these 3 steps. Then when it comes to types of investors, there are so many types of investors. Individuals are just one types of investors. Then banks, insurance companies may we had 2: general insurance companies, which is property and casualty insurers, and life insurance companies. Then we had sovereign wealth funds, endowments, defined benefit plans. Okay, this brings me to the point, defined benefit plans and defined contribution plans. Do you remember the difference? I am your employer, you all are the employees. Along with your salary every month I'll be giving you an extra amount, and the investment risk is on the employees, which is this plan, defined contribution plan. But in defined benefit plan, I promise you to give you some pre-specified amount every year during your retirement. That becomes defined benefit plan. I have committed to you. Now the investment risk is on me as an employer. So for the employees, defined benefit is better. For the employer, defined contribution is better. Most of the companies follow defined benefit pension plans in order to attract and retain talent. Yes? Okay. Now, when it comes to risk tolerance, for banks, the risk tolerance is low because they need liquidity, because it depositors money and all is at stake. So, but for endowments, the risk tolerance is very high. For years and years, they don't need the money. They can invest for very long time horizons. Now, when it comes to insurance companies, the risk tolerance is usually low. But if I talk about life insurance company, it would be slightly higher as compared to property and casualty insurers, because life insurance companies, when they sell insurance, for a long time, they know that the claims are not going to come from those claimants. But property and casualty insurance, we say it is lumpy in nature. Lumpy means uncertain in nature. Anything could happen anytime, burglary or car accidents or loss by fire, and the claimants may come anytime, right? So it is lumpy in nature, and hence the risk tolerance capacity of property and casualty insurers would be low. Okay. When it comes to risk tolerance of defined benefit plan, what about them? It depends on the characteristics of the workforce. If you all are my employees and you are very young, I can take high risk and invest in high risk securities, knowing that your retirement is very far away. I mean 20-25 years down the line, like that. Okay. Mutual funds, also one types of investors. What about mutual funds? Risk taking capacity of mutual funds, honestly it depends on the type of the fund. Depends on the type of the fund. If it is a debt fund is naturally low risk as compared to equity fund. An equity fund, maybe if it is a large cap fund, it would comparatively be less risky as compared to a small cap fund. So it depends on the type of fund. Yes. Now when it comes to liquidity requirement for a bank would be very high. Means they would be investing in such securities which are highly liquid. They cannot afford to invest in illiquid securities. I'm not saying that a bank won't invest in illiquid securities. They will, but I'm talking about the majority of their investments which would be in liquid securities. Endowment can afford to invest in illiquid securities, and which is what they do. They invest in private equity and all, which are highly illiquid, because they know that for a long time they don't need the funds. Okay. Now guys, please understand liquidity is different from income. Liquidity requirements and income requirements are different. I have invested in a bond that gives me income. but that may not necessarily be liquid. So if I have workforce which is nearing retirement and I have invested in bonds, income is of great importance to me. I should be getting the coupons, and preferably high coupons, so that I can give it to my workforce who would be nearing retirement, like that. Then it's okay if it is not liquid, like that. Okay, fine. Liquidity requirements for a mutual fund, again I would say it depends on the type of mutual fund. Liquidity requirement for an individual, again I would say it depends on the individual himself or herself. Okay, fine. Now if as an individual I am saving for a goal which is 20 years down the line, so for me the liquidity requirement would be low. But I am saving for a goal which is coming through next year, so for me the liquidity requirement in that case would be high. So can I say time horizon also decides the liquidity requirement to a great extent? Okay, fine. And so does your risk taking capacity. So time horizon is very important. Okay, I had given you that example also. If you have spare funds and you have to pay your credit card bill in the next 20 days, would you invest in stocks for those 20 days, or would you prefer to invest in liquid funds? Liquid funds, because least risky, liquid funds, and stocks are very risky. What if you invest in stocks for those 20 days and then boom, your money gone in case of a downside? So never do that. Your time horizon here is very low. Okay, now talking about mutual funds, various types of mutual funds: debt mutual funds, equity mutual funds, gold mutual funds, and whatnot. Even within equity mutual funds, so many different types of mutual funds: small cap fund, large cap fund, mid cap fund, flexi cap fund, multi cap fund, and the list goes on and on. Okay, having said that, open-ended mutual funds and closed-ended mutual funds, do you remember the difference? In open-ended mutual funds, you want to buy and sell the units, and mutual funds mein there will be units, don't say shares, units you want to buy and sell. Will you go to the open market or will you go to the fund manager? Fund manager. But in case of closed-ended mutual funds, buying and selling of the units happens in the secondary market, just like normal shares. Okay, in India 9:15 to 3:30 that time. Okay, and I'm not discussing those extra things which I had told you in class, that which NAV is applicable and all that. From an exam perspective, that is not important. That was just for your knowledge, which I had discussed. Okay, fine. Then we had discussed ETFs, exchange traded funds, again traded on secondary market. Now exchange traded funds mein, how was the scenario? If you want to buy and sell additional shares, you can go to the secondary market. But I had explained you the concept of a creation unit. Nifty Bees mein creation unit size is 50,000 shares. So if you are willing to buy at least 50,000 quantity, then you can approach the fund house directly. But anything below that, you go and do it in the secondary market. What is the price at which the ETF trades? Is it the NAV or the market price, which is determined through the forces of demand and supply? Market price. ETF always trades at market price. Closed-ended fund also trades at market price, but an open-ended fund would trade at the NAV. I had told you how to determine the NAV. We had discussed that in the lecture, the method of determining NAV. Does NAV remain same every day, or it changes? Changes depending on the share price movement. The NAV also would change. Share or bond, whatever the security price movement, accordingly the NAV also would fluctuate. Mutual fund open-ended schemes, the NAV is decided once a day at the close of market hours, right? Okay, fine. And in case of secondary market traded units, the price keeps on fluctuating every now and then, just like normal shares. Okay, now in case of ETFs, or take any kind, ETFs, open-ended funds, closed-ended funds. Open-ended funds, you guys come and redeem it. You had bought some units of the open-ended fund, you come to me and redeem it. Will tax be applicable on that sale? If you are making a capital gain, will tax be applicable? Yes, tax of course will be applicable. Why? Of course it will be applicable. Okay, yeah, so where were we? ETFs. Okay, so tax will be applicable definitely, but as a fund manager of an open-ended mutual fund, when I buy and sell shares, that time tax is not applicable. Okay, tax is only applicable when unit holders sell the units. Okay, that too if it is a capital gain. Okay, fine. Now discussing about private equity, venture capital, hedge funds, we had something of that also in this chapter, portfolio management and overview. Anyway, that we had discussed extensively in alternative investments, but since it's there here, let's just discuss it a little. Private equity pooled investment vehicle, alternative investments, it's a part of alternative investments. Venture capital also a pooled investment vehicle, and so is hedge fund. Private equity, the fund manager is called what? General partner. General partner invests where in case of a private equity? Usually private limited companies, and a sizable stake I buy. Okay. Venture capital fund mein the general partner fund manager invests where? Startups. Okay. Between private equity, venture capital, where is the risk of failure more? Venture capital, because you are betting on a baby. Okay. You don't know how is that baby going to grow up, whether is that baby going to grow up at all or no. Okay. Hedge funds, they take high risk investment strategies, trading, shorting, trading on leverage, etc. Fine. PE funds are also called as buyout funds, okay, because they buy out a large stake. Now, not that private equity funds don't invest in public companies, they do invest in public companies, but mostly if they invest in public companies and if it's a sizable stake, they take it private, as it happened with Hexaware Technologies in India. Okay. But in some cases, private equity funds also invest in public companies and let it remain public, but that is when their stake is not so high. Jaise Blackstone had invested in JB Chemicals and Pharma. It's a listed company when it was invested, and still it continues to be a listed company. So that transaction, we call it a private investment in public equity. Okay, fine. Now, as a private equity or a venture capital fund manager, general partner, is my job only restricted to investing, or then following up, monitoring the investment, adding value to the company? All that is also involved, but in case if I'm a mutual fund manager, my job is only restricted to investment. I am not going to go and advise the company, do this, do that, and all that stuff. Okay. Active management versus passive management. Where are efforts involved? Active management. Passive management is pure copying. Okay. Fees is high where in active management or passive management? Active management, because active efforts are involved. Now see, many fund managers have been unable to beat the benchmark which I had discussed. So more and more investors are moving towards passive investing. Okay. Now there is something called as a core satellite approach. Core satellite approach is when you don't believe in the benefits of active investing, majority portion of your portfolio you passively invest. Passive investments may so many types: ETFs, index funds. Okay. Or else if you have sufficient funds, you directly invest in Nifty 50 stocks in the same weightage in which they are in Nifty 50. Okay. So that, and the satellite part of your portfolio, little bit, you keep it for active management. That is what is core satellite approach. In India, passive management is increasing, but in US it has already increased a lot. Passive management, passive investing in ETFs and all. Okay. Now it comes to traditional investments and alternative investments. Traditional investments is where we all can participate as individuals, also stocks, bond, gold, etc. Alternative investments we already discussed. Now there are some asset managers who focus only on traditional investments. Some asset managers focus only on alternative investments. So it depends. Multi-boutique asset firm means what? They do everything. I mean, in traditional, they do everything: stocks, bonds, currency, commodity, gold, everything. Then there are specialist asset managers who focus only on one particular asset type where the expertise lies. Okay. Fine. I had given you the example of TIMO, Timberland Investment Management Organization. That I can call it as an example of specialist asset manager, focuses only on timberland investing. And I had shown you hectares and hectares of land. Okay, fine. Now, what else in this chapter? When it comes to minimum investment in an open-ended mutual fund or a closed-ended mutual fund. In an open-ended mutual fund, is the minimum investment specified? Yes, it is always specified. It could be either 100, 500, 1000, whatever, as specified by the scheme. And in case of ETFs and closed-ended mutual funds, can I say the minimum investment is the price of one share? So if ETF is priced at 280, which is the case with Nifty Bs right now, so that becomes a minimum investment. At least one share I have to buy. Okay. Now when it comes to short selling, can you short sell ETFs? Yes, just like normal shares, you can short sell ETFs, but you cannot short an open-ended mutual fund unit. Okay. Can you buy ETF on margin, means on leverage? Yes, you can buy it, but open-end mutual funds you cannot buy on leverage. Okay, understand that. Fine. Okay, now little bit on robo advisors. Robo advisors is basically wherein you have to fill a questionnaire. The robo will ask you your KYC type of a thing, and basis that it will recommend securities to your asset allocation and all that. But the problem with robo advisors is that it has a mass appeal, yes, because a lot of them can use it because the fees is less, but then it tends to give the same investment recommendation to most of them at a lower cost. So then that renders it meaningless. Okay. And one more thing is that it tends to give more of conservative advice, because then if it gives aggressive advice and then you act in accordance with that advice, and if something goes wrong you would tend to blame the robo. So in that case it tends to samne se give conservative advice more. Fine. Okay, so that was all in first chapter, an overview. Is there anything that I'm missing out on? Okay, fine. You have any doubts in this chapter, please feel free to ask. Load and all I had discussed, load funds, entry load, exit load. Entry load has been banned by SEBI in 2009. They had banned entry load in order to encourage people to invest in mutual funds. Earlier, what was the situation? If you wanted to invest in a mutual fund, whatever was the NAV of the unit, along with that you had to pay an entry load, now which used to discourage a lot of investors. If you want to promote mutual funds, you have to, do away with all this entry load and all. Exit load is still there. Matlab, if you sell your units within 1 year, exit load will be applicable, like that. But that too, there are certain limits and all which you can read in the scheme documents. If you remember, I had shown you scheme document of a mutual fund where there was expense ratio, AUM, and all the details were shown. Okay, fine. Now moving on to the next chapter, basics of portfolio planning and construction. To a great extent it is linked to this chapter, portfolio management and overview. We will be discussing the incremental parts. Okay, here again in this chapter the repetitive part is that while portfolio management, what are the factors you should take into consideration, the liquidity requirements, the tax situation, the time horizon, same to same as what we had discussed in the first chapter. So here the incremental part is the core satellite approach, which we have already discussed. Core part of your portfolio passively managed, satellite part is actively managed to take little bit benefits of active management as well. Then you remember the return objectives and risk objectives. It can be either absolute or relative. Absolute return objective means minimum 8% returns I want in a year. Relative return objective means in relation to a benchmark. So if I am investing only in large cap securities, if my fund manager is investing only in large cap securities, I compare his performance to a large cap benchmark, which in India is Nifty 50. Okay, it has to be an apple to apple comparison. A large cap fund manager's performance, please do not compare it to a Nifty mid cap. That won't be an appropriate comparison. Okay, so that becomes a relative return objective, that whatever Nifty 50 delivers, I want at least 3% over and above that. Okay, and by the way, if I have to ask you, anything delivered in excess of the benchmark returns is called what? Alpha. Okay, anything in excess of the benchmark returns. Fine. Now risk objective also either can be absolute or relative. Absolute risk objective, my portfolio standard deviation should not exceed 15% in a year. Absolute, I'm not comparing it to anything. But when it comes to relative risk objective, my portfolio standard deviation should be at least 2% less than benchmark standard deviation. Okay, at least it should be 2% less as compared to benchmark. Now I am comparing it to a benchmark, so it becomes a relative risk objective. All four possibilities are possible: return objective absolute, risk objective absolute, return objective relative, risk objective relative, return objective absolute, risk objective relative, return objective relative, risk objective absolute. All four possibilities are possible. Can I ask you, where will it be mentioned, whether it is absolute or relative? Where will it be mentioned? IPS, investment policy statement. Okay, fine. Now this chapter focuses a lot on IPS also. What are the components of IPS? You remember guidelines, appendix, then constraints and all that. So that part you read it carefully. Okay, fine. And IPS, what is the main purpose of the IPS? Is it that to act as a ready defense against any client lawsuits? That is never a primary objective. I'm not here to fight with y'all. Okay, you are my clients and let's prepare IPS, so tomorrow if dispute happens, so I can take IPS and act as a ready defense. That IPS can act as a ready defense. That is not the way to look at it. But main purpose of IPS is that it could help achieve our goals with collaborative efforts. Okay, if an IPS is prepared always by the fund manager or by the client, or is it the collaborative effort? It should always be a collaborative effort. I want inputs from you and I will also give you my expertise, and that is how we will prepare the IPS so that it helps us better align with our goals. I'm not saying it's a guarantee that goals will be achieved only just by the preparation of an IPS, but at least it helps us go in some direction. Okay, now when it comes to ability and willingness to tolerate risk, already I have discussed ability always dominates the willingness. You judge a client's ability by looking at the client's assets, bank balance, and all those tangible things, and you judge a client's willingness by mainly asking questions to the client, mainly getting into the brains of client to know what their thought process is. That's how you determine the willingness. Okay, fine. And strategic and tactical asset allocation we had done in this chapter. Strategic asset allocation is the broad breakup, 60% equity for example and 40% fixed income based on the client's risk and return requirements. Now if I see as a fund manager some short term opportunities, can I deviate from strategic asset allocation? Yes, I can deviate to take advantage of the short term opportunities, which I call it as tactical asset allocation. But then that should only be for short term, it should not be permanent. Then again I have to rebalance and get it back to the strategic asset allocation levels. Okay, whether or not tactical asset allocation is allowed by the client, that also will be mentioned in the IPS. How much bandwidth is allowed, plus minus 5%, plus minus 10%, everything will be mentioned. Yes, so this was all about basics of portfolio planning and construction. Major focus in this chapter should be on your IPS part. Okay, read that part carefully. Okay, any doubts in this chapter? Okay, fine. You can let me know in case if I have missed out on anything, so I'll cover that part also. Fine, can I proceed? And it's okay in case if you don't remember right now, if you remember it towards the end, you can ask me at that time also, we can discuss it, not an issue. Portfolio risk and return part 1. Now let's discuss that. This involved some practical part also. Okay, now portfolio risk return part 1. There were calculations and very important ones. How to calculate the riskiness of a particular security. What is the measure of riskiness of a particular security? Standard deviation, but that is the measure of total risk, total variance. If you only want to calculate the systematic variance, then for that you calculate the beta of a security. Now standard deviation, I had taught you logically how to calculate standard deviation. The entire formula we had derived it in class, but then I had given you a Calci shortcut also how to do that. For exam purposes, always follow the Calci shortcut. Sx is sample standard deviation, sigma x is normal standard deviation. What we had observed is they have always solved the question in accordance with sample standard deviation. So you also first give preference to sample standard deviation, and then if the answers are not matching, then you calculate normal standard deviation sigma x. Okay, if you remember the formula, this was the formula for normal standard deviation sigma x. What was the formula for sample standard deviation? The same, except that in the denominator, numerator was the same, denominator it was n minus 1. Wait until cons. This is a concept of degrees of freedom, you'll understand there. Okay, fine. Then we had learned the calculation of correlation, covariance. Correlation has to be between two securities. I cannot calculate correlation of one security. So it has to be two securities. So security A and B. So if you remember, correlation between AB was covariance between AB upon standard deviation of A into standard deviation of B. Now if I ask you which measure is a bounded measure and which one is unbounded in nature, correlation is bounded in what range? -1 to +1, both inclusive. It can be +1, it can be -1. Covariance is unbounded in nature. I had shown you multiple calculations. Okay, it can take on any values. Which one is more practically used? Correlation, because it gives you a standardized number. Now what does -1 signal? It is perfect negative correlation. +1 is perfect positive correlation. If you want to achieve diversification in your portfolio, would you want the correlation between the securities to be high or low? Low, more towards the negative side. But here again there was a catch that you need to know. If between asset class, I am seeing the correlation between asset class needs to be low, between asset class, but correlation within an asset class needs to be high. We had discussed the reason also why. Okay, so please be very careful about it. Okay, in case if you get a question in exam where they ask you to calculate covariance, so can you calculate it like this? Correlation AB into standard deviation A into standard deviation B. If this info is given to you, so this is how you can calculate the covariance, just an algebraic rearrangement. But the other way to calculate covariance was, this was the formula if you remember, sigma x minus x bar into y minus y bar upon n. Now here we don't do the squaring and all, because we had discussed the reason signs get dissolved, and sign is of utmost importance when it comes to correlation covariance. And if they ask you sample covariance, just this one difference. Correlation has a Calci shortcut which I had shown you. Covariance does not have a Calci shortcut, but still we had jugaad karke we had found out some calculator shortcut for covariance also. Please make use of that shortcut in case if they ask you in the exam. Okay, please, calculator shortcuts are extremely important, which you have to know. Okay, fine. Now there were three types of investors which we had broadly discussed in this chapter: risk averse, risk seeking, risk neutral. Remember? Okay. Risk averse investor means, does it mean that that investor won't take on risk? No, that was not the meaning of a risk averse investor. A risk averse investor would take on risk provided he is compensated with sufficient returns. He is so hungry always for returns. So for a given level of risk, if a risk seeking investor wants this much of return, a risk averse investor would want this much of return. That was the meaning of a risk averse investor. And risk neutral investor is not concerned with risk at all. Wherever the returns are high, that investor would go there. So standard deviation is of no importance to a risk neutral investor, right? Okay, now basis this concept we had learned utility function. If you remember, utility function is expected return of a security minus 0.5 into variance into lambda. Lambda was what? The risk aversion coefficient. If you remember that, risk aversion coefficient. Risk aversion coefficient is 0 for risk neutral investor. It is positive for risk averse investor, and it is negative for risk seeking investor. Please guys, they could test you in MCQs, so better to know this. Okay, and you all of course know how to calculate this. Just ensure one thing, that you take stuff in decimals. We had seen the problem of taking whole numbers when we were calculating correlation covariance. So please be safe always and take it in decimals always. Okay, fine. Now I had taught you the concept of efficient frontier, shown it practically on Excel, how to plot an efficient frontier and all. So your y-axis and x-axis, your y-axis is for expected return and your x-axis is for standard deviation risk. We had plotted it on Excel, it was coming exactly same. Efficient frontier. Now that combination which has the lowest risk is called what? Global minimum variance frontier, and any portfolio above that is an efficient portfolio, and this line is called as Markowitz efficient frontier, and this part below the global minimum variance portfolio consists of all the inefficient portfolios. inefficient portfolios on this line as well as anything lying over here. These are all the efficient ones. Okay, fine. Now the moment I introduce a risk-free security into the picture, I get what? You remember, I get one line, capital allocation line. Capital allocation line by introducing a risk-free asset into the picture. At the point of tangency, which is this portfolio called optimal portfolio, which consists of 100% of risky assets, the market portfolio. Okay. Now when it comes to the market portfolio in capital allocation line, is it the same for all investors or can it differ? It can differ when it comes to CAL, but we had learned a concept of CML also, capital market line. There the assumption was that all investors have homogeneous expectation, and there the market portfolio is the same for all investors, which is an absurd assumption, but just for concept. Okay. Now market portfolio, does it necessarily consist only of equity shares? No, it could be anything. Equity shares, real estate, alternative investments. Point is, it should be the same for all investors. Okay. At the point of tangency, we have optimal portfolio. I repeat, 100% in market portfolio. Now, if you are having a portfolio which is lying towards the left of optimal portfolio, do you remember what such portfolio is called? Lending portfolio. Perfect. It's called lending portfolio, wherein you are investing some part of your money in risk-free securities and balance part in risky portfolio. But if you want to take on more risk, see, as you go up above the capital allocation line, your riskiness increases because, see this, more standard deviation. Anything, any portfolio which lies towards the right of the optimal portfolio is called as what? Borrowing portfolio, where you are borrowing at the risk-free rate and investing in the risky security, right? But now again, if I want to discuss the practicality, borrowing at the risk-free rate for you individuals, it won't be possible. Even for corporates, borrowing at the risk-free rate is not possible. So that one limitation you understand. Okay, fine. Any doubts in this? Okay. Utility function you want to see? This. You have any doubt in this? No. This is nowhere mentioned. It's a part of the curriculum. Okay. Fine. Okay. Now, if you remember the concept of indifference curves, indifference curve means what? You give me this combo, for this level of risk you give me this much return, I'm okay. You give me more returns and samne more risk, it's okay. I'm indifferent between any point on this curve. Okay, that is why it is called an indifference curve. I'm literally indifferent between any point on this curve. Let's term it as I1. Would you prefer a security that lies on I2 over I1 or I1 over I2? I2 over I1, because for the same level of risk, you are getting more returns on I2. Tell me, which one over which one? I3 over I2 and I1? Fine, as you go up above the surface, you prefer that indifference curve, but it should be achievable also, na? It's desirable, but it should be achievable. Now, how do you decide whether or not it is achievable? You see where your CAL is passing through. If your CAL is passing from I2, then I3 is not achievable. Point of tangency is what is achievable. Had your CAL been passing like this, then I3 would have been achievable. Okay. Now I have taught you how to plot the CAL, the efficient frontier and all. Let's not get into those details. That was just for a better understanding. But right now, for the purposes of revision, I hope you are able to recollect all this. Okay, fine. There was a concept that risk-averse investor will have steeper indifference curves. Now see, this indifference curve is for risk-seeking investor. For this level of risk, wants this much return. Now, if I have to draw For a risk averse investor, it will be like this. Isn't it steeper? Now for the same level of risk, the risk averse investor is demanding this much return. So in case if you are tested in MCQs, you should know that risk averse, higher the risk aversion, more is the steepness of the indifference curve. As the risk aversion reduces, the steepness also reduces. Okay. And one more point which was corresponding, higher the level of risk aversion, higher would be the lambda coefficient. Lower the level of risk aversion, lower would be the lambda coefficient. It can go in negative also. Negative is for whom? Risk seeking investors. Remember that. Okay. Fine. Between mid cap, small cap, large cap stocks, historically, which has been the riskiest? Small cap. Okay. Fine. Small cap stocks are the riskiest of all. But historically, if I ask you which has given the largest returns, small cap. Small caps have given highest returns. Okay, fine. But then again, this point is little controversial. If I consider a big time period, then large cap stocks have given better returns. Big time periods mein. Small cap stocks in short time periods, they have given better returns. And small cap stocks are highly risky. Sometimes they give good returns, but then it's like cyclical. Okay, fine. Is there anything in this chapter that I'm missing out on? Please remind me on a time-to-time basis. Discussed everything. Just ensure one thing. Portfolio standard deviation formula looks dangerous, but trust me, it is not. I had told you the logic of the standard deviation formula of portfolio. And please ensure you take everything in decimals. Now, correlation between AB, if it is 0, means there is no relation between the two. Now, just because a correlation between A and B is 0, does that mean portfolio standard deviation would become 0? No, we had discussed that this term will get eliminated, but there is at least something under the under root. So there will be some portfolio standard deviation. If you want to reduce portfolio standard deviation, then the correlation should be more and more towards the negative territory. There was one more formula for portfolio standard deviation. You substitute covariance in place of correlation AB into standard deviation A into standard deviation B. That much part you substitute with the covariance part. Okay, fine. Are returns anywhere there in the portfolio standard deviation formula? Nowhere. Returns are not included anywhere. So in the question, if they give you returns, understand that is just to confuse you. It has no usage in the formula. Okay, fine. Now moving on to portfolio risk return part 2. Part 2 mein, the first thing that you remember I had taught you was linear regression. Because if you don't know linear regression, you cannot understand portfolio risk return part 2 properly. Linear regression, if you remember, y is equal to mx plus c. Y was what? The dependent variable. M was called the slope term, X was the independent variable, C was the intercept term. Slope term interpretation was what? For every 1 unit increase in the independent variable, the dependent variable will increase by the slope term. Intercept term interpretation was what? For every, if the independent variable is 0, dependent variable would be equal to the intercept term. You understand the interpretations? Do you remember all that? Okay. Now your entire portfolio risk return part 2 to a great extent was based on linear regression. Okay. If I have to discuss capital market line, dependent variable will lie on the y-axis or x-axis? Y-axis, which was the expected return. Your independent variable, do you remember in CML what was the independent variable? What was the slope term? Sharp ratio of the market was the slope term. You forgot everything. Okay. And this was the intercept term, this risk-free rate. Okay. Now, regression equation of the CML line is what? Expected return is equal to RF. This is the intercept term plus slope is what? Sharp ratio of the market portfolio. RM minus RF upon sigma m, and independent variable is standard deviation of the portfolio. This is how I had logically taught you to construct the equation of the CML. Okay. Now, if you go to remember this, it will be difficult for you, but if you know the concept of regression, you can construct it on the go. Fine. Okay. Now, what does this intuitively tell you? The more risk you take in your portfolio, the more would be the expected returns. So, returns are a linear function of the risk taken. Okay. Fine. Now, the same thing we had done for SML. If you remember SML, at least the full form you tell me. Security market line. Now, y-axis expected return. X-axis instead of standard deviation was beta. Okay, now tell me the difference between beta and standard deviation. We had discussed beta is used to measure systematic risk. Standard deviation is used to measure total risk. Okay. Now, again, linear regression. RF being the intercept term, expected return is equal to RF plus beta being the independent variable, and slope term was RM minus RF upon, there was something upon, tell me what, 1, which was beta of the market. Since it is upon 1, we don't write it, but you should know. Okay. So this gives rise to what? What is this called? RM minus RF into beta plus RF is also called as what? CAPM, capital asset pricing model, wherein it's a single factor model. Single factor and multi-factor model, do you know the difference? Single factor model is only one independent variable. Multi-factor model, we have multiple independent variables, more than 1, 2, 3, 4, whatever. Multi-factor models also we had learnt in this chapter. Do you remember which ones were the multi-factor models? One was Pharma and French model, wherein there were how many independent variables? 3 independent variables. Now, 3 independent variables. One of it was the CAPM, which was RM minus RF. This was one independent variable. Then, which is called excess market return, by the way. Excess market return was one. Firm size was second. Firm book value upon firm market value was the third independent variable. This was the Pharma and French model. So you take the independent variables, the inputs you give it, and accordingly you will get the output in the form of expected return. And each independent variable will have what attached to it? Remember one thing, each independent variable has a slope attached to it, and that slope is what we call beta, also called as factor loading. So here you can name it as beta 1, beta 2, beta 3. So as many independent variables, that many number of slope terms will be there. This was a 3-factor model under multi-factor. Then we had done 4-factor model also under multi-factor model, which was the Carhart model. 3 factors from Pharma and French plus one more. The 4th factor was momentum. Now can I say momentum will have its own beta? Okay, fine. Now, as per a study, Carhart model is effective in predicting the returns, but my comment I had told you, it is highly dependent on the time period selected for the study. So don't take their language on face value, note the practicalities also, okay? But I hope you are able to recollect this. Now, in the multi-factor model, there could be either macroeconomic variables or fundamental variables or statistical variables, but more emphasis is placed on macroeconomic variables and fundamental variables. Macroeconomic variables matlab which affects the entire economy. Fundamental factors matlab firm specific. Now firm size, is it macroeconomic or fundamental? Fundamental. Firm book value upon firm market value, again fundamental. CAPM would be more of a macroeconomic variable. RM, return on market, is for the whole market, right? Okay, fine. Proceed. I hope you are able to recollect all this. Very important. Okay. Now SML may we had done one thing. As per the beta, if the beta is low, then as per the CAPM, these are the expected returns as per CAPM. If beta is high, these are the expected returns as per CAPM. If beta is this much would be the expected return as per CAPM. Why am I telling you this? Because you compare the expected return as per CAPM with the required return. Now expected return as per CAPM, let's say, is this much, okay? And by other method, required return comes out to be this much. Undervalued. This security is undervalued. CAPM is underestimating it, whereas actually it could deliver more returns. So the best way I'll tell you to remember is that anything lying over the SML, opposite, undervalued. Anything lying below the SML, opposite, overvalued. Anything lying on the SML, fairly valued. Right? Okay. And one difference between SML and CML was, there were two differences in fact. On the CML, on the x-axis, we take standard deviation. On the SML, on the x-axis, we take beta. The second difference was that on the CML, only the efficient securities would be plotted. Only the efficient portfolios would be plotted. Inefficient portfolios would be plotted below the CML. But in SML, whether it is efficient, all the portfolios would be plotted on the SML as per their respective betas. Then you have to just compare what is the required versus the return as per the CAPM, and then you decide whether it is undervalued or overvalued. Okay, got it? Fine. Then we had done something called as attribution analysis, wherein we were comparing the performance of multiple fund managers. There were three things which I had taught you: Sharpe ratio, Trainer ratio, and Jensen's alpha. Sharpe ratio as a measure is used to compare multiple portfolio managers. Which one is delivering the best returns for per unit of risk taken? So remember guys, it's a risk adjusted measure of return. So Sharpe ratio formula was return on portfolio minus the risk free rate upon standard deviation of portfolio. Trainer ratio formula was return on portfolio minus risk free rate. The numerator is same as the Sharpe ratio, but denominator here in case of trainer ratio was beta of the portfolio and not the standard deviation of portfolio. Please remember that. Practically I had told you which one is used more. Now trainer ratio assumes that all the unsystematic risk has been diversified away. So what remains in the portfolio? Only the systematic risk. That is why trainer ratio was using beta in the portfolio. Now this reminds me of systematic unsystematic risk. Do you remember that? Systematic risk was entire overall risk. Unsystematic risk was company specific risk. Systematic risk was which affects the entire market: inflation, exchange rate risk, war, etc. Firm specific risk, death of a CEO, product failure, etc. That is a firm specific risk. Unsystematic risk. As per portfolio theory, you shouldn't expect compensation for bearing unsystematic risk simply because it can be diversified away at little cost. Now how can I say little cost? Because you buy an ETF, no? Matlab you are having indirect exposure to so many shares. So you are technically diversifying away your unsystematic risk as per the portfolio theory. So you should expect to get compensation only for bearing on the systematic risk. But I had practically told you about hedge funds and all. They specifically take on unsystematic risk because then the expected returns also could be higher in that case. By the way, unsystematic risk, apart from being called the firm specific risk, it was also called as idiosyncratic risk. Okay, remember these terms. Fine. There are some more terms. When you read the chapters, you would know. This dependent variable is also called as endogenous variable. Just check it once in the book. These terms are jargons, basically jargons. It's called as endogenous variable, and independent variable, I think it's called as exogenous variable, right? Fine. Yeah, so that jargon. And dependent variable is also called as explained variable. Independent variable is also called as explaining variable, because dependent variable is dependent on what? Independent variable, like that. So just some jargons that you need to be careful about. So that's why I tell you, just read the chapter carefully. In case instead of dependent, independent variable, if they use such words, you shouldn't get confused. Okay. Then in risk return part 2, we had done Jensen's alpha. Jensen's alpha was what? Return of the portfolio minus return as per CAPM. Now if it is positive, so well and good, your portfolio is delivering excess returns over and above that predicted by the CAPM. So Jensen's alpha is positive. Now for Jensen's alpha, I don't need 2-3 securities. I can just compare an individual security's performance, whether it is positive, negative. But for Sharpe ratio, Treynor ratio, such measures, I need 2-3 other funds also in order to do a proper cross-sectional comparison, right? Then there was the concept of M squared. M squared used to give you the same answer as Sharpe ratio, just that it was stated in percentage terms. Now in case if they ask you a numerical question on M square, you should know the M square formula also. So M square goes like this. This is the formula for M squared. Now Sharpe ratio of portfolio, can you guide me? What would be the Sharpe ratio of portfolio? Return on portfolio, don't say RM. RM stands for return on market. I am talking about return on portfolio. Portfolio could be different for different investors. Minus RF upon standard deviation of portfolio into standard deviation of market plus the risk-free rate. Now can I say standard deviation of market would be the same for everyone? Risk-free rate would be the same for everyone. Matlab your M squared majority is driven by the Sharpe ratio of the portfolio. That is why I tell you that whatever ranking the Sharpe ratio measure gives you, the same ranking M squared would give you, but just in percentage terms. Sharpe ratio is not in percentage terms. Okay. In case if they ask you the M squared, this is the formula. Fine. Okay. We'll be discussing more when we discuss questions. I'll be taking numerical questions also on this. Don't worry. Okay. For now, are things clear in portfolio risk return part 2? Okay. Please be very clear with the concepts of linear regression, and thereon you build the concepts. I hope it was helpful for you. Okay. ठीक है. Can I proceed? Okay. Now we discuss, am I missing out on anything by the way? Which? Beta calculation. Good reminder. Beta calculation. Okay, let's just check it once. Beta calculation was covariance between security and market upon variance of the market. Right? There was one other way also to write the beta, or you can mention beta as correlation between security and market into. Now, I'll give you one trick to remember. Which is the dependent variable, security or the market? Security, a dependent variable, standard deviation always on the top. Okay. And divide by standard deviation of the market in the denominator. Fine. Okay. This was another way to calculate the beta. So based on whatever info is given in the question, you accordingly decide which formula to use. Okay. Correlation into standard deviation of dependent variable on top, standard deviation of independent variable in the bottom. I'm not deriving this because I had already derived during the lectures. Right now I'm just giving you a shortcut to remember it. Okay, fine. Beta of market is always 1. Beta of security, if it is above 1, matlab it is riskier as compared to the market. It is more sensitive compared to the market movements. If the beta is less than 1, it is less sensitive as compared to market movements. Now, between a real estate company and a pharma company, which company would have a higher beta? Real estate, because it is more risky. The riskier the security, more would be the beta. Okay, so defensive stocks, stable stocks, they have less beta. Cyclical stocks and all have more beta, indicating their higher riskiness. Okay, fine. So with this, we complete risk and return part 2 also. Let me know in case if you have any doubts. Okay. Now we discuss behavioral biases. One of the most interesting chapters. Behavioral biases. Are human beings rational? No, you will see a lot of irrationalities in this chapter. There are two major types of biases: cognitive biases, emotional biases. Which one is difficult to correct or almost impossible? Emotional biases. Cognitive biases, with some proper education and guidance, I can correct it. Cognitive may also there were two types: belief perseverance and information processing. Okay, belief perseverance biases may there were various subtypes, so on in case of information processing. So first let's discuss belief perseverance biases. Here the main underlying message was you are suffering from cognitive dissonance. I had given you one example in the class. Left me on scene, not replying. I thought okay, must be busy. Deep inside I know that everything is over. You remember that example? Okay. So belief perseverance. What was the mnemonic I had given you to remember? Hi Crick. H for hindsight bias. Arey yaar, you should have bought that stock. See, I told you. You remember all your good decisions, but you forget your bad decisions, which gives you a lot of overconfidence. Arey, I told you it happened like that only. So that is why, you know what? The fun fact is, hindsight bias is also known as I knew it all along phenomenon. You knew everything every time. Just that you remember your good decisions. Okay, bad decisions you forget. Hindsight bias. So I had told you the ways to correct hindsight bias is that you maintain a diary. Whatever decisions you are taking, maintain a diary, write them down, so you will have a proper track record of where you were going right or wrong, and accordingly it can just, you know, lower your ego of knowing everything. That's what you feel. Hindsight bias. Then high crick. C stands for confirmation bias. You actively seek that information which confirms with your existing beliefs. Okay, knowing that you may be wrong somewhere, but you are suffering from cognitive dissonance. You have difficulty processing something which goes against you. I bought a car, remember faulty airbags, that example. Okay, C, confirmation bias. So how to cure your confirmation bias? Go to such unbiased people to seek advice. They will most likely give an unbiased opinion. Okay, now if I have Tata Chemicals stock, and if I go to the MD of Tata Chemicals to ask about the stock, of course the MD is only going to give me good things about the stock. So then again I would suffer from confirmation bias. So I shouldn't be seeking opinion from such people. Okay. R, representativeness bias. In R there were two: base rate neglect and sample size neglect. In base rate neglect, you know, the underlying message that I had given you was you are ignoring the bigger picture in favor of the specific information. COVID vaccination example, I'm just touching upon the example so that you can quickly recall. People hospitalized, that one. Okay, then sample size neglect. That fund manager performance, I'm judging only the performance of last 3 years. He has done exceptionally well. Oh, I'm super impressed. Is that a big sample size to consider last 3 years? No. At least check his performance over a decade. So then you won't be suffering from sample size neglect if you consider a bigger sample size. Okay. CRI, illusion of control bias. You feel you are in control of everything. You are the chief executive officer of a company. You feel everything is happening within your control only. So that's not necessarily the case. There are so many things which affect the stock price about which you have no idea absolutely. And I had discussed with you that there are some things which cannot be measured. Recently only I had given you so many examples. You remember? Lehman Brothers went bankrupt within 3 days. Archibald Hill, marathon runner, he had found out that heart health is related to your athletic performance, all those examples. So underlying message is that some things cannot be measured like that, and they cause majority of the difference. CRI. And last C was for conservatism bias. Was what? Conservatism bias. You are slow to process the new information. So please be quick enough to process the new information. And why are you slow to process new information? Because it may be causing you some discomfort. Underlying message being cognitive dissonance. High crick. Okay, I had given you the example of Mukesh Ambani handing over the throne to his kids. So then I'm slow to process that information. Should I be quick enough to process? Of course, there are so many things happening in the market every day that you have to be on your toes. Information becomes stale in no time. So better be on your toes. This was belief perseverance. Now let us discuss information processing biases. The mnemonic that I had given you to remember was FAMA, F for framing bias. The way information is presented to you affects your decision making. My mom had asked me to buy a washing machine, sale, remember? Framing bias that we discussed. Okay. Now when it comes to financial statements, framing bias would be in case of MDA, management discussion and analysis. So they would tend to speak good only about their company. So first focus always on numbers, then focus on MDA. That's how you avoid the framing bias. Okay. FA, FAMA. A stands for availability bias. Only the information which is available in your vicinity, in your surroundings, you tend to base decisions on that information. Okay. Within availability, if you remember, we had considered 4 other types. Narrow range of experience. If you remember my example, who is the best looking? Saudi, Arabs that we had discussed. Example yaad rakho yaar. Okay, available. This was narrow range of experience. Then resonance. Resonance matlab personal, your personal experiences. I had given you my example. Someone comes for my lecture. If you remember. Yeah, see, he remembers it. Someone comes for my demo lecture. I tend to get too angry in that particular lecture. Otherwise, I'm super calm. So that person, what impression that person will have in mind? Ke, Arey, he's so getting very angry and stuff. But that was just a one-off phenomenon. You remember? Then his experience would be based on this only, resonance. So that just an example. Huh? I'm not like that. Okay. Anyway. Then third one was retrievability. Retrievability, whatever you can easily remember. Who's the best actress currently? If I ask, so Tripti Dimri. See, she said Tripti Dimri. Retrievability, which is easily recalled. So that again leads to availability bias. But we all know for a fact that the best actress, if you dig deeper, is Chitrangada Singh, right? Okay. Okay. Let's not get there. And then finally categorization. I'm using the same framework of small cap stocks to analyze large cap stocks. Now does it make sense? No, but I'm using it because that was what was available. So I'm wrongly categorizing it. These 4 subparts are very important, nowhere mentioned in the book. Okay, fine. M, mental accounting bias. By the way, just for your info, availability bias is also called as recency bias. Okay. M, mental accounting bias. You are making separate bank accounts and all your incomes and all you are seeing from a different angle. You remember the tax refund I had received? I consider it as a bonus and I splurged it. Credit card, gift points. You remember that example? Gift cards I had got. I considered it as a bonus and spent it recklessly. Okay. Also, I had told you which bank's credit card not to buy. Axis Bank's credit card not to be bought. Okay. Fine. FAM, mental accounting. So now how to cure this mental accounting bias? You tend to see all your investments from one viewpoint. I mean a helicopter view. Because if you don't, if you make bucket wise investments for different goals, who knows, you end up selecting such securities when seen in combination have very high correlation. Do you want that to happen? No. That is why you first only see everything from a helicopter view, so that you tend to select such securities which tend to have low correlation in order to avoid the mental accounting bias. Okay, fine. FAM, and last A stands for Anchoring and adjustment bias. Anchoring and adjustment bias was what I had given you an example of group discussion in class. Topic is economic scenario. Someone starts off with recession, then entire discussion would tend to revolve around that. So the first piece of information tends to get more weightage. If I have to give a speech somewhere, my initial 5 minutes I would impress the audience to such an extent, then even if I do shit talking, people will feel I am a very good speaker, because the first 5 minutes I had set the tempo in that manner. So that was what was anchoring and adjustment bias. You see this on CNBC and all that, the reporters, they interview the management of the company. Management would give such impressive answers, initial few answers, that you tend to have a good image about the company. You are basing that entire decision based on initial few answers, which was anchoring and adjustment bias. So the cure is to see the overall picture and then come to a conclusion, right? Okay. These all were information processing biases. Now comes the most important, emotional biases. What was the mnemonic? Loser. S square. Okay, because there were two S's. L, loss aversion bias. You feel more pain for 100 rupees loss than you feel the equal happiness for 100 rupees gain. Okay, 100 rupees gain won't give you that much happiness as 100 rupees loss would give you the kind of sadness. Asymmetric preferences. This is what is loss aversion bias. So in loss aversion bias, what tends to happen? That investors tend to hold on to their loss making investments and they quickly sell their profit making investments, and it should be vice versa typically. Okay, if it is a loss making investment, please don't hold on to it, otherwise you would be making more losses. Just see fundamentals of the stock. If the fundamentals are good, then you hold on, then that's not a problem. In fact, you buy more. But then if the fundamentals are not good and if the stock is in red, in losses, then you sell it. You will cut your losses and move on, because if you don't, you would be missing out on other important opportunities, right? Okay, and here also anchoring and adjustment bias I would introduce. Hindustan Unilever example I had given, my buying price 2800. I used to consider that as the anchor point. So that anchoring and adjustment bias, one more example, the anchor point gets more. Now all the decisions I was basing on that price of 2800. Now if it is below 2800, naturally I would tend to have that loss aversion bias. Now since it has crossed 2800, now I am feeling better about it. Okay, fine. LO, overconfidence bias, very difficult to cure or almost impossible. That is a person's nature, and a person's nature, remember, does not change. Okay, if you are toxic, you continue to remain toxic throughout your life. If you are sweet, you are sweet. Okay, fine. So overconfidence, maybe there were various other points that you need to know. Self-attribution bias. Self-attribute, all this is an example, please. Self-attribution bias means what? You are blaming others for failure, but you are taking all the credits for success. Self-attribution bias. Okay. Then illusion of knowledge bias. You know everything. This is overconfidence. Now I had discussed one thing, that illusion of control and overconfidence biases, they are more or less the same, but it is more appropriate to classify it under emotional biases, under overconfidence bias, because it stems from a person's nature rather than the inability to not understand or something. Inability to understand something like that. It is more stemming out of a person's nature. So emotional biases it would be more appropriate to classify. LOS, status quo bias. Status quo bias, let it remain as it is. Because of inertia, laziness. I had given you the example of PF, Provident Fund money, in my first job. Remember that? We kept the allocation same. Everyone was too lazy to change the allocation, like that. LOSS, self-control bias. Youngsters getting their first job, but first salary, what you want to buy? iPhone 16 you want to buy. But that is lack of self-control, which shouldn't be the case, but it is difficult to change it. It's also called as what? Hyperbolic discounting. Then what will happen? Throughout your youth, you just partied, spent like there's no tomorrow. Then you are nearing your retirement thinking, realizing that there's no corpus now left for your retirement. Then you start taking on risk. to accumulate corpus. These are the side effects of self-control bias. Had you had self-control right from the initiation, then such problems wouldn't have come. Okay, fine. S, self-control. E, endowment bias. You tend to value a particular thing when you have it more as compared to not having it. So for example, I bought some shoes, I did not like it at all, but now since I have it, I wear it. I've convinced myself that these are good shoes, yeah, something trendy, endowment. But if I hadn't had those shoes, I wouldn't have bothered to buy it even if it were for 100 bucks, right? Okay. Zomato shares example I had given you, grandmother. Okay. Endowment bias may also, can I say that things are remaining the same as they were before? But is this due to inertia? No, this is due to some other reason. Inertia is linked to status quo bias. Okay. LOSSE. Whether or not, by the way, whether or not you are suffering from endowment bias, ask yourself one question. Would you have bought this today at the current price? If the answer is yes, you are not suffering from endowment bias. If the answer is no, you are suffering from endowment bias. Means today if you wanted to buy, you wouldn't have bought. So then why the hell are you holding on to that? Means you're clear cut suffering from endowment bias. Okay. LOSSER. R stands for regret aversion bias. You are not doing something, inaction, in order to avoid regret. Grandfather left a lot of FDs. Remember that example? Okay. Now here, am I not doing something? Is my inaction stemming from inertia? No. It is simply stemming because I want to avoid regret. That is regret aversion bias. Okay, fine. So you recall all these biases. Then there was one more which is called as home bias. You tend to invest in your home country's securities, be it stocks, bonds, whatever. Maybe because you are more familiar with the laws here and any court cases and all you can easily handle if it is in your home country. Then halo effect, judging a particular person or thing or a company based on one or two attributes. A particular startup appointed XYZ person as the chief executive officer, then that chief executive officer is a Harvard MBA. Oh wow, so impressive. Now this company is poised for growth. Just on the basis of one factor, I judge the company, but is that appropriate to do so? No. Similarly, you can have halo effect in case of stocks also. Just because a stock has recently shown good performance, the stock price is appreciating. But you get impressed. Now you don't know the reason why it is appreciating. Maybe because some operator is driving that stock up. Maybe because it's a penny stock due to some rumors, XYZ. Anything could be the reason. But because of that one factor, you are having a favorable image about that company. So don't jump the gun so quickly. Understood this halo effect? Okay. Momentum. Momentum was what? If a particular security is increasing in price, it continues to increase in price. If a particular security is falling in price, it continues to fall in price. That is the momentum effect. Also, momentum, you tend to catch the momentum in order to avoid which bias? Regret aversion. Otherwise, you would have the FOMO, fear of missing out. Why did I not participate in this rally? I should have participated. You want to avoid regret. That is why you are doing something. Okay, fine. Then we had done that quote also, don't confuse brains with bull market. I had given you my relative's example. Okay. Now that relative was minting money because markets were booming. Even if you would have invested money, that market was such that anyone would have made money. So you tend to have overconfidence because of that. Okay, wow, what are your stock picking skills? No, that thank the markets. And don't confuse your brains with bull market. Actually, you're not brainy. It's just the market that's helping you. Okay, fine. So all these were your biases. I hope you recollect all these biases. Okay, fine. Any doubts here in these biases? Okay. Bubble means the market is going up, 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 and there is no sound basis for the market to go up. Neither are the company's earnings increasing, nor there is any good future about the company or anything. Just that people are going on buying. That is what is creating the bubble. In short, market increasing without any reason, which happened post COVID. Market went on increasing, it formed a bubble. And why the bubble amplifies is because then people start having FOMO. Oh, the market is going up, up, up. Let us catch the bus, otherwise we will miss out. So then you also invest, which then further amplifies the market. Then all it takes is one pin to bust that bubble, and then gone. I don't see that bubble bursting anytime soon. I mean, it's just going up, up, up. In case if the bubble bursts, then it's going to be very bad. But I don't see that happening. Okay, fine. Understood this? Okay. Now, last chapter of portfolio management, introduction to risk management. Again, a lot of theory in this chapter. Risk management. In simple words, my organization is having a risk tolerance of 100 units, is exposed to 80 units of risk. Do we have the bandwidth to take on more risk? Yes. So we take on more risk. So guys, remember one thing, risk management does not necessarily mean taking on lesser risk. It can even mean taking on more risk, provided if it is within your capacity. And always don't see the risk alone, don't see the returns alone, always focus on the risk adjusted returns. And the more risk you take, the more returns you could fetch. So risk adjusted returns always is superior. What is in your control, return or risk? Risk is in your control, so please focus on that. Okay, effective risk management means what? Risk per unit of return, risk adjusted return. Okay, for which we have learned several measures, Sharpe ratio, Trainer ratio, and all that. These are risk adjusted measures of returns. Okay. Then there were financial, non-financial risks. If you remember, financial risk matlab directly related to market. Credit risk. Credit risk means what? Risk that the issuer won't honor the interest payments and all on the bonds. Credit risk. Then there is liquidity risk. What if the shares, bonds and all are difficult to buy and sell? That leads to liquidity risk directly related to market. And the third market risk was interest rate risk that we had learned. When interest rates increase, bond prices reduce. Now that's directly related to the market. Exchange rate risk also is a market specific risk. So all these are financial risk. Non-financial risk are the multiple. Solvency risk. Then reputational risk of the company. Tail risk. Tail risk means what? Probability of extreme events. Probability is very low of such extreme events, but when it happens, it causes a havoc. COVID-19, Russia-Ukraine war, all these are tail risk events, which we call as black swan events. Then there was legal risk. I had given you the example for legal risk. What was the example that I had given? Do you remember? No, for regulatory risk, I had given you an example. Legal risk was so simple. Regulatory risk, I had given you the example of ITC. Within 100 meters of schools and colleges, what is not allowed? Pan bidi shop not allowed, which causes risk to cigarette manufacturers. Okay. So, point is, such risk could keep cropping up, and so many risks about which you had no idea also. Such risk also could crop up. Okay. Then this, actually there are so many, how much ever I discuss, it's going to be less only. Accounting risk, model risk. Accounting risk matlab there could be fraudulent accounts, because accounts may a lot of subjectivities involved in preparing accounts. Model risk, you are using wrong models to analyze securities. Then personnel risk, operational risk, and etc, etc. Fine. Okay. Now in the risk management chapter, they had given you some basics. How is the risk management process done? First and foremost, at the enterprise level, the board of directors, they decide the risk tolerance, which is called as risk governance. Risk governance means determining the risk tolerance. Then next step, we do the risk budgeting. Okay, to which unit of the organization, how much units of risk are to be distributed. I had taken the example of JK Shah classes. CA, CS, CMA, CFA division. Okay. Then the next step is computing the risk exposure and measuring it to the risk tolerance, and accordingly taking appropriate steps. If you want to increase the risk, if it is within the bandwidth, you can increase. If not, then you need to reduce the risk. When it comes to reducing the risk, how do you reduce the risk? By buying insurance. That is called risk transfer. You can use derivatives also. to manage your risk, which is called risk shifting. Now I've given you one simple way to remember. Made a lot of losses on derivatives. I had to sell my house. I had to shift. So risk shifting is associated with derivatives. Risk transfer is associated with insurance. Is it necessary you have to take insurance for all risk, or some risk you could self-insure? I mean, you could tolerate some risks. You could tolerate some risks, no? Because see what happens is, if you go to buy insurance, is it for free? You will have to pay insurance premium. Now you realize that the insurance premium is much more as compared to the benefits that you are getting. So in that case, you tolerate the risk, no? Okay, fine. Now, for example, if I am traveling somewhere and the travel insurance is too expensive, and I feel that the risk is not going to be that much. I mean, just for a 2.5 hour flight, I don't think that the risk is going to be too much. So in that case, I don't take the insurance. So the point I'm trying to make is, it's not compulsory that you have to take insurance every time, naturally. Okay, fine. Then they had given you risk for individuals, longevity risk and mortality risk. Of course, as individuals, we also face a lot of risks, but the focus here is mainly on longevity and mortality risk. Mortality risk is the risk of early death. Longevity risk is the risk of living too much beyond your life expectancy also. So how to mitigate the mortality risk? Your family members were dependent on you. I was the only breadwinner. So what do? I buy a term insurance. So in case if something happens to me, my family could get the term insurance payout. That is how you mitigate the mortality risk. Longevity risk, I only exceeded my lifespan. Now I need money to survive more. So in that case, I buy an annuity. Annuity is an insurance product which gives you a constant amount every period for the set number of years, so that you can spend out of that. Okay, so that was an insurance product, annuity. Then we had discussed various measures to measure the risk. When it comes to measuring the risk of bonds, there is a measure called duration. Duration is used to measure the risk of bond price fluctuation. Now, those who have not done fixed income, don't worry. We will explain in depth in fixed income what is duration, how it is calculated, what exactly it means. So there it will be pretty clear. But those who have already completed fixed income, they would be knowing the duration. It's used to measure the risk. Higher the duration, more is the riskiness of bonds. Okay. Standard deviation, needless to say, everyone has learned it. Standard deviation is a measure of volatility. Okay. Then beta, again, it's a measure of systematic risk. We all know how to calculate. We know the interpretation also. These are various measures of risks. When it comes to derivatives, derivative risks is delta, gamma, vega, theta, rho. Again, now, what I don't like here is that delta, gamma, vega, theta, rho in this detail is discussed at level 2 derivatives, and they have introduced it as level 1 concept just to give you a glimpse. But unless you understand derivatives properly, you wouldn't be in a position to understand the delta, gamma and all that. So for now, I think you just have to read it. But those whose derivatives is done, delta measures the risk of option premium, the movement of option premium in response to change in the underlying asset price. Gamma measures the change in delta in response to change in the underlying asset price. Vega measures the change in option premium in response to change in volatility of the underlying asset price. Rho measures the change in option premium in response to change in the risk-free rate of asset. Theta measures the option premium falling every day due to the time value decay. Now, those who have not done derivatives would have gone bouncer. You wouldn't have understood this naturally. So it's okay completely. Once you do derivatives, you would at least have some fair bit of idea about this. Okay, fine. What else? Risk management, infrastructure and all that basic theory, people and all constitute the infrastructure, systems and all. I had given you the example. I was in a bank. There was a separate risk management department which was called market risk department. That was the risk management infrastructure of the bank. Okay, consisted of people, softwares, etc. Okay. Anything else? VAR is value at risk. Now, the way you calculate VAR, there are several methods to calculate VAR. Historical simulation, parametric method, Monte Carlo simulation. Now, how to calculate VAR? You at least have parametric method in level 1. So, when we do quants, you would understand. Those who are done with quants, Roy's safety first ratio, do you remember? That was a measure of VAR calculation. Okay, anyway, VAR, let's learn the interpretation for now. Interpretation of VAR is what? Say for example, I calculate the VAR 5% and 10 million. Matlab, and daily basis. Matlab, per day, there is 5% probability of a loss. And if that 5% probability of loss actually happens, what could be the minimum loss? 10 million. That is what is the interpretation of VAR. Now, if I say 5%, 10 million, 1 month. Matlab, in a month, there is 5% probability of loss on any given day. And if the loss happens, at least 10 million would be the loss. Now here I am not saying daily there is a probability of 5% loss. Monthly there is a probability of 5% loss. So the time period also is important. Minimum. VAR always tells you the minimum loss. If you want to know how much could the loss exceed over and above the minimum loss, you calculate conditional VAR. Now that is beyond your scope, how to calculate conditional VAR and all. There are many more VAR measures, incremental VAR and all, but those are level 2 concepts. Okay, fine. Did you understand this? Okay, anything else that I'm missing out on? Sensitivity analysis, stress testing. Sensitivity analysis is what? Changing one or more inputs and seeing its effect on other inputs. So for example, I have prepared projections for the next 10 years. I want to undertake a new project and I take my projections to the boss. My boss tells me, okay Mihir, you have assumed a sales growth of 10%. Change the sales growth from 10 to 15%. Let me see the impact on net profit and various other ratios. Now all this sensitivity analysis and all is done on Excel spreadsheets, which is formula linked. So the moment I change something, the impact on other things can be quickly known because everything is linked by formulas. That was sensitivity analysis. You can change 2 or 3 things also simultaneously and see the impact on the other thing, like that. Then there was scenario analysis. You remember my boss had told me prepare a project report. I prepared 3 reports: base case, worst case, best case. Base case mein I take normal assumptions, best case mein I take extremely optimistic assumptions, and worst case mein I take extremely pessimistic assumptions. This also is a tool of risk management, so that my boss reading the report would come to know that in case if worst case also were to happen, what could be the loss that we could face and is it tolerable for our company, so that the boss would have an idea. So scenario analysis also extremely important. Okay, fine. Stress testing means what? Let me give you a very simple example. Banks do this stress testing. So there is one ratio called as liquidity coverage ratio. So which measures that in the next 30 days, if the bank goes through an extremely difficult time, you depositors would start withdrawing your money. So that represents cash outflows for the bank. So the bank estimates that in the next 1 month, in extreme case, the cash outflow could be 100 rupees. Can I say the bank needs to have assets worth at least 100 rupees in order to honor these cash outflows? And that too liquid assets in the form of investments and all, or in the form of hard cash. And bank has liquid assets of 120. And expected outflow in the next 1 month due to extreme stress scenario is how much? 100. Are your liquid assets enough to cover all these outflows? Yes. So this is what is stress testing, liquidity coverage ratio. This was just one example. Like that, there could be many such metrics. Okay, I hope you understood the concept. Fine. Any doubts in risk management? Okay. There is one concept in this chapter, risk management, interaction of risks, which is very important. Understand that. Are the risks independent of each other or interrelated with each other? Interrelated with each other. Now see what happens is, I have entered into a derivative contract with a counterparty. Okay. Now I have entered into a contract with you. You are the counterparty. And you fail to honor the contract. Now that becomes a counterparty credit risk. Okay. Now counterparty credit risk happens. So will I stay quiet? I will approach the court of law. Now that leads to what? Legal risk. One risk leading to another. Last May you don't make the payment. Matlab, the assets which I was going to sell it to you at a particular predetermined price. Let's say we had entered into a contract that I will sell the assets to her for 20 lakh rupees. Just an example. You did not honor the contract. Now I have to sell it in the market at a lower price naturally, which again leads to another risk. You saw it was a chain event, one risk leading to other risk. So risks are highly interdependent with each other. They are not independent of each other. I hope you understood this. Okay. Anything else that you need to know? Surety and fidelity bonds. Surety bonds means what? Again, let's extend this example only. I have entered into a contract with you. Now I have that fear that you might not honor the contract. So with an insurance company, I buy surety bonds. So insurance company promises me to compensate me in case if the counterparty to the contract doesn't honor the his side of the performance obligation. That is surety bonds. Fidelity bonds means what? In case if your employees only do some crime within the organization due to which the organization has to face losses, so the insurance company would compensate for such losses if you buy fidelity bonds. Of course, it's not so easy that you call the insurance company and they will indemnify. Lot of survey and all will happen before indemnifying, before compensating. Understood? Anything else that I'm missing out on? I think I have covered everything. Entire portfolio management. I have covered everything. Every nook and corner of portfolio management. In case if I have missed out anything, please let me know. Now, approaches to ESG, negative screening. Now here telling you my focus would be more on ESG, environmental, social and governance practices. Now negative screening means what? ESG is so much at the heart of it that if I see any company violating the ESG requirements, I will exclude them from the purview of my analysis. That is negative screening. So for example, a steel company is still using blast furnace to manufacture steel. Is it environment friendly? No. I'd explain you the concept of blast furnace, electric arc furnace. So I exclude this steel company from my analysis. I won't be analyzing it. Negative screening. Positive screening means what? I specifically look for such companies which are meeting the ESG requirements. I view them very favorably. I'm very happy about the fact that they are following ESG practices willingly. So positive screening mein I'll specifically hunt for such companies. Then comes thematic investing. Now I have set up a fund. I will only fund those companies which are engaged in promoting the ESG practices. Now for example, you are running a company which is involved in R&D of environmental products. Good, she is doing something good for the betterment of the environment. I'll fund you. I'll fund your company. You are doing something to promote social causes. You are doing something good. I'll fund you. So I'll fund only such companies which are there to promote the ESG causes. Okay. Then there is impact investing. Now here I will fund those companies, but here my goal would be to earn decent returns also. Thematic investing mein the goal was not to earn returns but to promote something which you feel which is good, and returns you may receive after a lot of years, but you are okay with it, like that. Impact investing mein returns also would be your focus. Then comes your engagement or active ownership. This you can consider like activist investing, which I had explained in hedge funds. Activist investing means what? Taking a sizable stake in the company and dictating the policies and all. Whether or not they follow, it's up to them. How much power you have, that it all depends on that. So what I'll do is I will take a sizable stake in the company and tend to influence the company to follow better ESG practices. That is what is engagement, or you can also call it active ownership. Okay, you're not passively telling the company, you have actually been involved yourself and telling the company. Involved yourself how? By buying sizable stake. Okay, even if it is not a sizable stake, even if it is a decent stake, you can still at least encourage other investors. Okay, let's focus on telling the company to promote sustainable ESG practices, because ultimately this company is ours. We have to be with this company for a long time, so it's better that it adopts sustainable practices so it doesn't face any backlash, and moreover as investors we don't face losses on our investments. Then last is ESG integration. Right from start to end, Start to end, what do I mean? Right from portfolio planning process to portfolio execution to portfolio feedback. In every step, you focus, you keep ESG practices in mind. Every decision you take, keeping in mind the ESG considerations. That is called ESG integration. From end to end, in every walk of your decision making, ESG factors are considered. Understood this? Okay, fine. Engagement active ownership point, which I explained you, in that I had given you the example of Amundi selling SBI bonds because SBI had funded Adani's Carmichael project. That example you can consider in active ownership. So actively Amundi withdrew the investment, sold the investment because it did not want itself to be associated with a company who funds projects which cause harm to the environment. So here also ESG considerations are kept in mind. Okay, fine. So finally I can say that I have completed everything. We took good time to do the revision, but I hope it was fruitful. Okay. Now for effective purposes, whenever you watch this lecture in the future, I would recommend you to watch it at 1.5x speed. Just telling you, it would be more effective. Okay, fine.